What's going on, dividend chasers? It's the Dividend Bloodhound here, back with another investing episode. Today we're talking about 3 of the best UK stocks that you can potentially buy for your portfolio right now. I've tried to be a little bit different, come from a couple of different sectors. I've got a growth stock, I've got a company that's still paying its dividends, and I've got a company that is not paying its dividends, hopefully covering a lot of interest of what you guys would like to see. If that sounds like something that you'd be interested in, then do please hang around after the intro. Consider liking and subscribing to my channel as well. That'd be absolutely fantastic. And yeah, I'll see you on the flip side of the intro for the main event in this video. Catch you there. Hey again guys, welcome into the video. So today I have the 3 best UK stocks that you can consider looking at in your portfolio for the month of November. Now, the US election has just about wrapped up, finally some of you might say, and we have Joe Biden as the projected winner. Now hold your horses just there a second, because Donald Trump isn't taking this lying down. He's not just going to roll over apparently, because he genuinely believes, maybe it is in his own little world, maybe it's substantiated, at the moment we don't know, but he's going to the Supreme Court, and apparently he's going to take this all the way there to contest this election result. So the world's media and most of the world now is thinking it's going to be a Joe Biden victory and inauguration, but there's just that tiny little bit of doubt there that's worth taking note of for the market. However, the market today has absolutely popped and has absolutely flown, because there has been a vaccine that has done particularly well in trials made by Pfizer, and that means that across the world markets have absolutely popped up 10-20% in some cases, many stocks even more than that. That being said, let's get in there and let's have a look at our first company. Now our first company is fast fashion clothing online company Boohoo. Now this company, its business model has been doing particularly well lately, especially with the global pandemic. However, its share price has been absolutely smashed by the ethical issue of potentially paying people either less than the minimum wage or using slave labour essentially to produce its clothes. I must say that it's not Boohoo itself that's doing that, more a company that supplies Boohoo with some of its clothes. Now the company itself has conducted a review into this and has gone on the record to say that this doesn't happen anymore, they do not use this supplier, but that has still affected the share price massively. Let's get into the app, let's have a look at Boohoo and see how it's doing and what its fundamentals shape up like. Hey guys, welcome into the app. So here we have Boohoo, ticker symbol B0 or OO. It has a market cap of 3.42 billion, a PE ratio slightly high at 51.53, revenue of 1.23 billion and an EPS of 0.05. It has a net income of 63.67 million, a profit margin of 5.16%, a low debt to assets ratio of 45%, which is pretty good. If we hop over to the growth metrics, we can see that it has a 3-year revenue growth rate of 54.59%, which is absolutely massive, and then a 5-year one at 61.23%, which is also enormous. EPS growth at 3 years is 48% and 5 years is 35%, and a EBITDA 5-year compound annual growth rate of 53% as well, which is absolutely enormous. There's no dividend to speak of with this company because it doesn't pay dividends, so we don't have to worry about that so much. This company is all about the growth. A current share will set you back £2.72. Back in September you could have got it for up at £3.77, and it's maxed in the last year or so at £4 before dropping all the way down to the 230s, and then peak pandemic all the way down to the £1.57. That being said, I'm going to wrap up there and I'll see you back in the real world. Hey again guys, welcome back to the real world. So my opinion on Boohoo is that the price at the moment is a good price to buy at. You can get in at the moment, ride out the negative headlines that have come from the paying less than the minimum wage or slave labour, whatever that is, on that one side. At least it is only the supplier that Boohoo can ditch rather than Boohoo themselves, but they are associated with them. So if you're in at the moment, you're going to have to ride this one out. But the fundamentals of the business and the business model actually work so well. I mean, those figures there suggest that, and they can't be bargained with, they can't be lied about. However, you are going to have to at least ethically sit on the fence and decide if it is for you, but you could make a significant return on this one as long as you're prepared to wait out the bad press. But with this pandemic, online ordering and fast fashion is still a massive thing, and they are still turning over an insane amount of cash. Next up, and our next company, is Ashted Group. Now, Ashted is an industrial hire company both here in the UK and over in the US and Canada as well. Most governments tend to build their way out of recessions. We've got a change of presidency coming in the United States, so that could, or potential change of presidency coming in the United States. So that could see a real change. Governments tend to build their way out of recessions, so we could really see significant spending on heavy plant hire. And here in the UK, just to name one significant infrastructure project, that is HS2. It is just starting to gather speed now. That if you don't know what HS2 is, it's a new major national rail project that's going to need huge amounts of plant hire to complete. Building from just the line from London to Birmingham is going to be a significant part, never mind the parts that are going to go on to Manchester and Leeds over the coming years. And guess what? They're going to need lots of heavy plant to do that, so you can guarantee that there'll be a revenue stream in it for Ashted Group there. Anyway, that's just a little slight digressment there. Let's get into Ashted's fundamentals on the app. See you in there. Hey again guys, welcome into the app. So here we have Ashted Group, ticker AHT. As I said, it's an equipment hire and rental company operating over in here, the UK, and over in the United States and Canada as well. It has a market cap of 12.68 billion, a low PE ratio of 12.94, revenue of 5.05 billion, which is massive, EPS of £2.19 and a dividend yield of 1.43%. Net income sits at 739 million and a healthy profit margin of double digits, 14.64%. As you can see, revenue has been rising year on year for the last 3 years. It has a debt to assets ratio of 71.78%, which is quite high, but nowhere near the 100% margin where alarm bells would seriously start to ring. If we hop over to the growth metrics side of things, 3 and 5 year revenue growth are 19 and 16% respectively. EPS growth at 3 year and 5 year is 21 and 17%, and its EBITDA 5 year compound annual growth rate is also 21.24%, which is pretty good. And a dividend growth rate over 3 years of 13.91%. That being said, it's been paying a growing dividend since 2006, and it's been heavily growing it since 2013, meaning a seriously good return on your investment. At the moment, its share price is £32.62p. The slight worry for me is at the moment you'd be buying at an all-time high. The share price has never been higher. Even pre-pandemic it was only £27.80, and then it dropped down to the £12.93 margin. If you got in then you did absolutely fantastic. And then yeah, so the issue I would have at the moment, the main issue is the risk of buying in at all-time highs. But it is an absolutely phenomenal company, and when I see you back in the real world, I'll explain exactly why. See you there. Hey again guys, welcome back to the real world. So Ashted Group, not only is this company fundamental to infrastructure projects that are never not going to happen, stuff and infrastructure always needs improving, at least in this country, and I know the same across the world as well. Motorways always need upgrading and building, train lines always need building, upgrading. That's just to name a few. However, the main reason why I wanted to say just how exceptional Ashted Group is, that in the last decade it has returned to its investors 242%, which is absolutely phenomenal, and it's been paying a dividend along the way. So you've gained, not only in that respect, you've gained to buy even more of the company with, but you've gained in the share price as well. The company's fundamentals are rock solid. The trouble is with that is you pay a high premium for it. As we can see, the stock price has never been higher at the moment. A lot of investors out there are switched on to companies through a little bit of research that are fundamentally strong, and this is just one of those companies, and you have to decide or wait whether you want to pay the premium or try and wait out to buy in, set yourself a price target and buy in at a later time. Great company, but would I buy in at a record high? I would say personally I would wait a little while to see if you can get a drop and get a little bit more value for money when you're investing. However, exceptional company. And next and last company that I'm going to go into today is National Express. Now, as you can imagine, National Express has been absolutely destroyed by the pandemic. They were really struggling at one stage because you've taken away all the passengers, and that's what this company does, is move passengers from A to B. And they don't just operate in the UK coach and UK bus market, they also operate US school buses in the German market, in the Spanish market, and in the Moroccan market. They aren't just solely UK based. However, passengers across the world were told to stay inside. So the company and the company's share price and the dividend got absolutely hammered, and the dividend is still out of the question for now. But what you can do is buy in at rock bottom prices and then get yourself some appreciation and upside, and then the dividends will return later down the line. Anyway, let's get into the app. Let's have a look at National Express's fundamentals. Welcome back into the app, guys. So here we are looking at National Express Group, ticker NEX. As you can see, the share price absolutely popped today. So it went from £1.65 to £2.06, 24% rise in a day, based on the market sentiment around Pfizer's 90% success rate with its proposed vaccine. Anyway, enough of that. So it has a market cap of 919 million, a PE ratio, an extremely low PE ratio of 5.34, revenue of 2.74 billion. And I must say, guys, sometimes when you look at a company and its market cap is less, and significantly a lot less than its revenue, it is at least worth looking at. I mean, sometimes there's an obvious reason for it, which we have at the moment, but usually it is a good sign if the company's revenue is more than its market cap and it is fundamentally strong and got a decent balance sheet and cash flow, then it is well worth looking at investing in. It has EPS of 0.28, revenue was 2.74 billion, net income is 141 million, and a profit margin of 5%. That could be better if I'm honest, but 5% isn't bad, but I would prefer it to be a little bit higher than that. The debt to assets ratio of 75% is also pretty high. However, when you consider that this company operates coaches, it owns a lot of assets, it probably has to get into debt to do that. It always has to upgrade the coaches as well after a certain amount of time. So that is why the debt to assets is as high as it is. If we hop on over to the growth side of things, for a mature company, 3-year and 5-year revenue growth sits at 8 and 9% respectively. EPS is 18% and over 3 years, and at 5 years is 8%. And the EBITDA 5-year compound annual growth rate is double digits at 12% as well, which is also particularly strong. As you can see there, the dividend growth is gone because it has been wiped out at the moment. National Express has been forced to cut its dividend and keep it under constant review due to, you guessed it, the global pandemic. That all being said, I'll see you back in the real world. Hey again, guys, welcome back. So that was National Express there. My opinion with this company is, even with this stock market pop in the price today, it is doing and is still incredible value for money. It's obviously been hammered by the pandemic. The stock price picked up a little bit today due to the vaccine and the sentiment around it. And of course, there's no dividend to be had at the moment, but you could jump in at these low prices, potentially make a really good return, double your money just in appreciation and upside alone, and then take into the account the dividends that will return later down the line. The balance sheet and the money that they have in terms of cash flow covers them for now. Bus travel and coach travel is essential to countries across the world, not just the UK, and they, you would imagine, would get assistance if required, or loans if required, from the government and from councils to keep that essential service running. I mean, they are still running a service at the moment which must be at either break even or at a loss, because a lot of people aren't using public transport at the moment, but yet they're still going. And I imagine 5 years down the line, 10 years down the line, when this pandemic has completely rescinded, the share price will have recovered, and so will it be paying dividends again, and a decent one at that. I hope you've enjoyed this episode today, guys. It's been absolutely fantastic to conduct the research, record it and bring it to you. If you could see your way to hitting that like button, that would be absolutely fantastic, and even subscribing to my channel and ticking that notification bell. Hopefully I'll see you in another investing episode. Catch you in the next one.